All right, everybody, we are live. Thank you for being here. Cashflow Chronicles, another beautiful day, February 15th. Apologies for my tardiness. Just got home from the office. We're working on an investment deal, so um, can't talk too much about that. Hot Chris, how you doing, man? How are
Good,
things?
man. Just trying to piece together some quick DD. I'm gonna post something hopefully tonight, maybe tomorrow night. We'll see. But yeah, I
On
wanted
the
to
Patreon?
continue on. Yeah, I'm gonna continue on a little bit with regards to some of the things that we were talking about opportunities in the market that maybe other people are not necessarily seeing. So we can go from there.
Yeah. And speaking of that,
Yeah.
you're in trouble now.
No, she's like, "Do you want some water?" I'm like, "No, I got it. I'm good."
Yeah, good man. Yeah, things are going well, man. Portfolio. I actually wanted to state something. I know this probably isn't a big deal for you because I know you're a little bit more concentrated in some of your investments, but believe it or not, one of my positions, I have multiple ETFs that are over 100,000, but I
Mhm.
actually for once have a stock that is over 100,000. So it's pretty,
Really?
yeah. So Palantir finally crossed that threshold when it crossed the $25 mark.
Congrats.
Yeah,
Congrats.
I was pretty surprised. There's a lot in the $50,000 to $60,000 range, and like I said,
Mhm.
I have ETFs that are in the multiple six figure range. Like my SPY position's pretty big, and then I have my 401k. That's all pretty much in the SPY as well. So like those are up there, but normally that's where I hold a lot of my value, and then I do some spot investing, like 4 or 5% positions, but Palantir, man, with its double, it really pretty much got me over that threshold of 100K. And there's a few
Nice.
others that, like, if they just take a little bit of a love, they could see the 100K, 200K mark pretty easily as well. So it'll be fun because that was kind of like
Yeah.
the first one, and I feel like once something happens for the first time, more and more happen in that sort of vicinity. So I'm looking forward to the next several years because I'm positioned myself for multiple 100K positions. Like I always
Yeah.
position Google, Amazon, a lot of these positions in my portfolio to be six-figure positions. So
Mhm.
um, nice. It's nice to have a single position that you're literally like, damn. Like I always knew I'd be there with SPY, and I did that probably a year and a half ago, 2 years ago. I finally divested in a lot of the stuff in the portfolio, consolidated a lot of it into SPY. So that's been over 100K, and my 401k
Mhm.
for God, probably over 5 years
You're
now.
a young guy, man. You're a young guy. You're gonna be on the private jet soon enough, bro.
No, I don't have that. I don't have that meet Kevin money. But anyway, I wanted to brag a little bit. I don't brag much about the portfolio. I try to keep a little bit
Mhm.
more private, but I thought that was pretty dope. Pretty much, yeah. And I think it's probably my biggest overall win as well. I guess aside from the um, the S&P. So it's definitely
What
the
happened?
biggest
You
individual
didn't. You
stock.
didn't. You didn't want to collect all the dividends from TSLY. What happened, man?
You know me, man.
You
You
know.
know me. I'm a huge whatever the yield max aficionado. You know me.
By the way, this is just the joke. Do not, under any circumstances, buy any stupid yield max um, ETFs. They're
Yeah,
literally, they're doing a reverse split.
I did hear that. I thought it was
Yeah.
a joke, but I did
I
unfortunately hear
can't
that.
believe that like they're actually allowing this shit to continue. It's crazy. It is
Yeah.
crazy.
I've tried to steer people away, but unfortunately, you sometimes you have to let people make their mistakes. And um, if people ever want to hear my thoughts on it, I'd be more than happy to dive down that rabbit hole. But if you want, Chris, we've had a phenomenal past couple days in the public portfolio. Would love to share that with everybody. We're up another $7 today, which is a big deal when you only have like less than 2 grand in the portfolio.
Hmm.
Um, so another 0.4% for us today, on top of an already pretty decent chunk. But I'm not sure if you have any other thoughts. It might be a shorter episode, but excited that we have 83 people here sharing it with us, regardless.
Yeah. So a couple of things I just wanted to quickly talk about. This is something. This is a little bit of a continuation from Finance Junkies.
Yeah,
Um, you know, if you really want to understand a stock, you have to also understand its balance sheet. And one of the things that you really should learn how to do is look into its capital and debt stack. Um, the company's ability to borrow money and at a certain rate and a certain price can really be a big determination on where it's going in the future. So,
Mhm.
every business to some degree has to have capital in order to use it to do other things. Now, most of the companies, what the reason why, they exist is to generate profits. What essentially companies do is they borrow money, they build out an infrastructure, or they hire somebody, or they acquire something X, Y, and Z. And in the process, they're basically paying back some of the debt, paying some interest charges, and then using everything else in order to generate value for shareholders. Now, there are times like right now where interest rates go up. Now, what happens? Some businesses are very lucky because they may have issued a lot of debt when times were good, when interest rates were low. So, if you look at their balance sheet, they may be blown up with a crap ton of debt, but the interest that they're paying on that debt is very small because they've got it so far out. They were able to use that really good time. And this is where a really good CFO comes in, where good CFOs know, like, hey, listen, right now is a good time to borrow money. Even if we don't need to borrow it right now, let's just borrow it because you never
Hence
know
why
when
Apple
things are
has
going to get
debt.
expensive. Right. So if you look
Yeah.
at Apple, Apple has, I think, over $100 billion in debt. Right now, Apple could just pay that debt off tomorrow morning. It's got enough cash to do it, but it's not going to, because the rate at which Apple borrowed that money is like 1%. Whereas now they can take that same money that they borrowed at 1% and lend it out in treasuries and get a 5% return. So essentially, they're making 4x return on the money that they just basically borrowed. So basically, they borrow at 1, they get 5.5. And because Apple does huge amounts of share buybacks, they can just use that debt to buy back shares. And that they have strong cash flow, this repeatable cash flow, so they don't have an issue with repaying the debt. It's such a great way to arbitrage unique opportunities. Now, on the other hand, if you carry too much debt, your business can also be impacted, because what happens is the interest rates can go up, and you can also have a lot of floating rate debt versus fixed debt. So those are the kinds of things that if you really dig down into the balance sheet, you'll learn how to do. And maybe we'll do a quick exercise on that. What do you think? Do you look into the debt stack like that, Matt,
A
for
little
any
bit. I look
investing?
at this. I look at the schedules a little bit, and I'm familiar
Mhm.
with companies and utilizing debt because I'd make a lot of investments within our organization, right? I work on the upstream project side, and we look at cost of capital. And for example, it's like if you're borrowing as a cost of capital with inflation ends up being 6, 7, 8%. Basically, when you do your NPVs or your net present value of all your projects, you're making sure that even if you're borrowing at a set sort of rate, which is inclusive of inflation, et cetera, that you're still making money at the end of the day. So yes, you might have to take
Mhm.
on debt to do this project, exactly what Chris is kind of talking about, but you have to meet a certain threshold. So even though you might have an IRR, an internal rate of return of 6, 7, 8%, your NPV
Yeah.
can still technically be zero because that's how much it costs you to borrow all the money and inflation and all that sort of stuff. So what you're looking for when you kind of do all these analysis, like for example, Apple, if they're able to borrow at 2%, 1%, like they were able to, and get a
Mhm.
return on capital of 20%, kind of no brainer, right? And so if you start
Yeah.
looking at a lot of these other projects as well, that's where you're starting to get into some tough places and why some companies are in such a bad place right now because one, they were able to borrow when it was say 3, 4, 5% for them. Now they have to go back to the market and get closer to 6, 7, 8%. And they're already a low margin business. So what might have been able to be done at a 5, 6% borrow rate in the past at a 6, 7, 8% now might be basically an NPV zero sort of some game.
Mhm.
And they might not necessarily have all the cash return from those projects. So if you made bad investments and stuff like that, and maybe all of them didn't pan out or what have you, you end up in the shitter. And exactly what Chris is saying, you kind of have to have a good CFO that understands these business cycles and actually when all the cash is going to start inflowing because otherwise you get
Mhm.
stuck between a rock and a hard place. Luckily, companies like Verizon, which Chris has been prudent about telling us about, has sufficient free cash flow to be able to pay down some of these debts, right? So the thing that's nice about it is, yes, you might have a bunch of capital on your balance sheet. You can issue more debt and pay back the old debt, but you should have a bunch of free cash flow that you're then able to kind of attack that debt as well. But
Mhm.
anyway, so that's my experience a little bit with
Yeah.
the debt
And
scheduling piece.
so here, I'll show you guys how to look up a company's debt and how it's impacted, right? So let's do a quick exercise on that. So let me just share my screen. Let's do this right here. So let's look at Verizon, right? I think that's a good example. So if you look at Verizon, sometimes the companies themselves will post it in their investor relations section. So Verizon actually is very clean. So they actually do post it. So these are like the debt ratings that Verizon currently has. So think of debt ratings as kind of like a report card, right? The higher you are with the report card, the lower interest rates that you can typically borrow at, right? So if you look at these right here, these are the current ratings for Verizon. Now, the way that you would look at it, I wish I could like do multiple windows, but I can't. So let me just go to Moody's. What's that thing called? Ratings chart. So this is Moody's ratings chart. Hold on. So I don't know if you guys can see this. Can you?
Good
Hold on.
enough. Maybe
It's
this.
another tab. Hold on. So let me 1 second. Stop sharing this one and share. I wish this thing was like a little bit like Zoom. It'd be easier to see,
A little
but
bit.
okay. So this right here. So you can see here, these are the credit rating agencies. This is what they each company's rated at. So the highest right here is AAA, which is prime. Usually companies like Apple, which have really strong cash flows, they're going to be at the top. And then you're going to have high grade, which is like a little bit less. So I'd say like this is A plus, this is like A minus. And then of course you have over here, which is like B plus, and then over here is like B's, right? So after anything after B's, you're typically running into non-investment grade, and it starts to get more and more and more speculative to the point where once you're in triple C's right here, you're pretty much junk at this point, you know. So it's very unlikely that you will be able to survive. Now that doesn't mean that you can't survive. It just means it's highly unlikely that you will. So a lot of times what happens is by the time that the debt gets to this level, if you look at what the debt is in the open market, it actually gets valued down lower and lower and lower. And so this is a major problem. So if you look at Verizon and Verizon's current report card, hold on 1 second. Let me just investor relations. Verizon's debt rating right now is A2. So according to Moody's, it's BAA1. So if you look at Moody's has it as BAA1. Then you have S&P as BBB plus, which is right here. And same thing with Fitch. Fitch actually gives them a little bit of a higher rating, so it puts them over here. So this is Verizon's debt stack. So they're kind of in between like an A minus and a B plus student, I would say, or more, you know. So that's how you would value it. They're still investment grade, but they're not in the greatest of place. You know what I mean? Whereas you'd rather be over here for like the top of the stack. So
Mhm.
number one, they can issue money at a certain price. Now, the next thing you have to look at is, well, how much can they issue it at? Right? Like what would be if let's say Verizon needed to issue new debt, like go into the open market right now and say, hey, I want to borrow $1 billion. What is it going to cost Verizon? So this is actually pretty easy. You go to Fred data. So you can see here on a corporate bonds things, this is
Mm,
actually published by the Fed, where you can actually see the current yield on a lot of those. So triple Bs right here are trading about this right here. So let's say we do a
Interesting.
1 year chart. So you can see here that they could borrow money probably at about 5.6%. Maybe probably if they really have to, because corporate debt, they have to juice up a little bit. They'll probably have to do like 6.5, maybe 7% new issuances. So if Verizon wants to borrow money right now, more than likely, based on the demand outlook, they're probably going to have to pay between 6.5 and maybe 7%. for any new issuances. Okay, this
Mm.
doesn't mean that the old issuances are repriced unless it's floating
Variable.
rate. It just
Yeah.
means, yeah, it just means that this is what it would cost new to issue, or close to it, because remember, everything when it comes to bonds is dependent on demand. If there's a lot of demand for it, the effective yield can actually be lower. But if there isn't as much demand, it can actually be higher. So that means that, you have to kind of like entice people to lend you money. And so the more you're willing to give an interest, the more likely it is that people will, give you money. So that's how the pricing works. But typically you can see here. Now, if you go back to like 5 years, you can see in 2021, you could have issued bonds. Look at this, at 2%. How crazy is that?
Hmm.
Right? Verizon, what they did was they actually borrowed a crap ton of money during this period right here, because they were undergoing their capital intensive plan where they were buying spectrum. So they took on a crap ton of debt when it was much lower, right? So we can go back to their credit now and their actual debt. So you can see that here. Let's see. Let's go back one. And this is all the schedule for their debt. So you can see here, these are the different debts that they have. So long-term debt, the maturity is like this one would be, this is $44 million at 6%. It matures in 2028. You have, let's look for some big chunky ones. Look at this one. This, they owe $1.3 billion dollars, and it's due in February. But look at the interest rate that they got it at, 3.3%, right? Let's look at something that's like super far out of the way. So let's say about 7 years from now, they borrowed 1.5 billion at 3%, right? How crazy is that they were able to borrow at such low rates?
Hmm.
you know so this is Verizon's pretty much their debt schedule. And then, like I said, this is where you kind of have to just be a little bit like mathy and understand where the debt is currently and how much interest is actually coming. A lot of this stuff you just put in a spreadsheet, you can look it up, and then based on that, you can actually tailor it so that on a quarterly and even annual basis, you can see how much debt is actually maturing.
Hmm.
So this is one of those opportunities that you can have. Now, there's another place that's actually better to find the company's debt, because not every company publishes their debt like this.
Yeah, I was about to
And
say, and I know a
yeah,
lot of companies that don't do that. Yeah.
yeah. And that's with the SEC. So you can actually go to the SEC and go to the company's filings, and usually it's called Edgar. So you can go to that, and actually, let me just latest filings, company name, Verizon. You can put it in ticker symbol too, but here it is, Verizon Communications. So here you can see all of the filings that Verizon has done. Usually when they do an annual report is when you'll get a lot of great information on their debt stack. Sometimes the quarterly is not as good. So the last time Verizon did a annual was right here, 10K, that they did it in February 9th. So let's look at that data real quick. This is right here. So this right here, you can see all the debt that they have. So all of these notes are all included in this filing. Okay, it's not telling you the dollar amount. It just says this is what the title of each class is. If you want to see what the actual amounts are, you can go to the debt schedule. Debt. Let me see. Da, 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 da. And they actually tell you, like as of December 31st, Verizon had approximately 128 billion in outstanding debt on an unsecured basis, 9.5. They still have a revolving credit facility that they can draw on if they really needed to, and 22 billion in outstanding in secured debt. So even when it comes to debt, there's two types of debt. There's unsecured debt, which is like, hey, I promise to pay you back, and then there's secured debt, which is usually on a fixed asset. So they say like, hey, this is secured by a specific asset. So this could be things like buildings. It could be things like,
Can we
even a
lose
brand
this?
name.
Oh,
Huh?
never mind.
Sorry.
Never
Yeah.
mind. I thought I lost you for a second.
So when it comes to secured debt is more just like it sounds. It's more secure, which means you typically can borrow at a lower rate than something that's more unsecured. If it's unsecured debt, it just means that it's like a promise rather than a fixed thing. So if you have like a mortgage on your home, that's a that's a secured debt, because basically the mortgage is tied to your property. So if you don't pay, the bank can take your property. You know what I mean? Whereas unsecured debt is something like credit cards, where the companies, the credit card company is lending you money, but you could just say, "Hey, I'm not paying it," and there's nothing securing that. And basically, it's not the full faith of the company's ability to pay. Most companies, they'll never they'll never want to go into default in one, because what tends to happen is the minute you get defaulted in unsecured, automatically the outstanding debt on the secured side also goes into default. So there's a lot of provisions in this debt, so that those provisions are very important to always keep an eye on. And yeah, we could, and that those are called covenants, by the way. So if anyone wants to look up what a covenant is, go for it. The way that I could best explain is that it's like rules, basically. Like the rules that the debt has to that the issuer has to follow in order to be current with their creditors. Being a creditor is awesome because you're guaranteed payment and you're secured more than you are with regards to like the equity holders. The equity
Yeah.
holders is a little bit more like up and down, up and down. You won't see that same thing happen when it comes to debt. So this is the annual report. They file a whole bunch of things on here, but I think the most important thing is finding out their current debt. Like, what is their current debt? What is their long-term debt? And this is where you can actually find all this stuff out. Sometimes companies make it very easy where they put it into a nice little chart for you.
And
Uh,
these trade too, right? Like a lot of these are on
yes,
the secondary market. So you can
yes,
take the opportunity to either buy and sell these. And Chris, I appreciate you showing me this Edgar website because there's several companies that are very diligent about putting them their debt schedules within, like for the next 5 years, within their
yeah,
investment presentations and their 10Ks and everything of the like. But there are some that are not. So
yeah,
there's been a few that I've actually been like scratching my head about, when are these things actually going to come to fruition? And especially it's like ADRs, like American Depository Receipts and stuff like that. So um, I need to go back and take the opportunity to look
yeah.
because this is going to be really useful. But this trades on a schedule. So for example, if somebody's issuing debt right now and there's say like a massive rate cut, then the value of that debt is going to skyrocket, right? In terms of the ability for you to sell it. Because
Yeah.
then, on the market, things are being issued at say 1-2%. If we say do a zero interest rate policy again, kind of similar to what we were doing during the pandemic time period. So if you're sitting on like a 5-6% yielding bond, you're pretty much holding on to gold because you could sell that for even double the price and the yield of it's still going to be 3%. So
Yeah.
it's that same sort of situation that you're talking about with being able to find these opportunities when you see fit. And there's also the chance that you can snipe in. Chris has done this in the past. I hope to do it as well in the future. Kind of like what we did with the preferreds, right? And that we have
Hmm.
in our portfolio. It's like if you find something that's trading for a fraction of the initial bond price, one, somebody might just be looking to get it off their books, so they might be selling it at a discount just to like get it off their books. But you could pick up like a cigar butt that's like 3/4 smoked and just hold it for a month or two and be able to get the coupon back, because everything's kind of issued at $1,000 or whatever for a lot of these bonds.
Hmm.
So you have that opportunity to do some of that with this if you notice it. But um anyway, just some
Yeah.
interesting key points there. But I really appreciate this piece because
Yeah.
there's a lot of companies that I'm curious about their debt stuff.
So this is where like when it comes to investing, this is where you do your fundamental due diligence and your analysis, right? So guys like me and Stephen Fiorello, we look at these kinds of things and say, okay, what does this company's debt structure look like? What is it? Where how much of it is currently being due? So right here, you can see that there's debt maturing within 1 year. There's about $12 billion, $12.9 billion worth of debt that's maturing. Right. So what is Verizon going to do about this 12.9 billion? Well, if you look at their free cash flow, right? Their let me just cash flow. They have more than enough money that they can oh, let me just do it from here. Cash flow. If you look at their cash flow statement from an operating income standpoint, you can see here that they're generating in 2023 they generated $37 billion in cash flow. They used 23 for capital expenses and whatnot, for like, for replacing phone lines and issuing blah blah blah, all those stuff. So that's where investing comes from. But then you have financing activities where they paid off $14.6 billion of debt. Some of this is other things too, but basically this company has a tremendous amount of operating cash flows that they can go into. So none of the debt that they have is actually that vulnerable. And as they pay off that debt, the value of the equity goes up higher and higher. So this is where, like I said, you just have to do your due diligence, understand how this company operates, and then what the value is. And sometimes you can even buy into their debt stack and get a
Mhm.
nice return from that. So
And this is where you're seeing the companies over the past, say, 2, 3 years. One, this is part of the reason why a lot of these regional banks have failed, is because you went from basically a 2% on, say, the 5 year, 10 year, 2 years, all the way up to closer to 4 or 5%. So that movement that quickly, obviously puts a huge strain on them. And that obviously is why companies like Verizon, AT&T have all been impacted as well, because they have a lot of this cheaper debt on their balance sheet. And everyone's anticipating, oh, well, they have $100 billion worth of debt. Now, instead of only having to pay $2 billion a year in interest, they're going to have to pay $5 billion a year. And it's like, well, that might be a problem for some companies, but for some of these other companies that are generating the amount of cash flow like Verizon is, it's really not that big of a deal. But you do have some companies that have probably overgrown, right? Like if they don't have prudent investment, they took the opportunity to take on a lot of debt, and now they're sitting here with kind of razor thin margins and being able to refinance. It'll probably do some companies in, to be very honest with you, if some of these interest rates don't go closer to
well,
where they
see,
were.
that's the funny thing. So the market is moving based on what the Fed is going to do next year. So if you look at a lot of companies that have a ton of debt like this, when the Fed says, hey, we're going to be higher for longer, these companies usually take a bit of a dip. Why? Because now everyone was kind of projecting out like, oh, we were going to get rate cuts starting March, which means that this company's value is going to go up because now they don't have to worry about the refinancing coming up. But then when the Fed says, hey, we're not going to cut till June, everyone's like, wait a second, what? That means that the debt is actually not going to be able to get refinanced at a lower rate right away. They're going to have to wait longer. And so, as the Fed pushes back that rate cutting scenario in the future further and further, that means that everyone's models end up shifting. What's good is that this is where the company you have to listen into these conference calls. You have to listen into how the company is operating, because companies can do certain things in order to mitigate some of those things. So, as an example, let's say you were expecting rate cuts in March, right? Your company is great. You think that they're going to rate cut. You're going to be able to refinance this debt that's coming due. Everything is going to be great. A year goes by, the Fed doesn't cut. So now you have to make some choices. Should I lay people off? Because how much layoffs can I get away with? Because remember, layoffs, when you do them, you're saving money. So now you can take that money that you're saving and deploy it into paying back debt. Also, you can kind of postpone some of the capital improvements that you were looking to do. So let's say you wanted to improve your factory in 2025. Maybe instead of doing it in 2025, you push it back to 2027 when the rates get into a better position. So this way, it gives you a couple of extra years to pile up that cash and pay down that debt. So when 2027 comes around and the interest rates are lower, you can borrow money at that time. The last thing you want to do is borrow money during a difficult time and then have to deal with the consequences of that debt going forward. So this is where a lot of companies, like I said, a lot of companies were very smart in 2020 and 2021. They just had massive amounts of corporate debt issuances. And so it really benefited them tremendously. And I think that's one of the reasons why a lot of companies right now they're still, surviving so somewhat, you know.
Yeah, I think
But
to kind of follow on with that, you'll hear a lot of companies talk about the CFOs, particularly when they're going through the financials. We're aiming for an A or an A minus credit rating, and that's kind of giving you an idea as to where you're sitting in. But I'm thinking of companies like NextEra Energy that took on a lot
mhm,
of debt during 2020, 2021. And I think that's part of the reason why the share price is down so much right now. But if you
mhm,
look at, say, a NextEra Energy as to what they're bringing online in the next 2 to 3 years, by the end of 2026, they're forecasting to basically triple the amount of output that they have from their renewables campaign. So they
yeah,
anticipate going from like 28 gigawatts per day to, or 21 gigawatt capacity to close to 60 gigawatt capacity, and then continue to grow with a huge backlog of opportunity. And so the hope is they basically were able to issue out a bunch of stuff in 2020, 2021 for 10-year bonds, and they'll be able to then start cash flowing much more once you
mhm,
get to that point, and slowly be able to chip away at some of that debt as time kind of progresses. Now they're going to have to refinance some of it because obviously it takes working capital, but the hope is that they're going to be able to get all these projects online that are yielding 10%, 11% sort of rates of return. And in fact, I think NextEra does a pretty good job. Their return on capital is kind of in the mid teens. So if you think about it, if you're able to borrow and put that capital to work in the mid teens, then hopefully you're going to be able to generate that delta, and really get yourself to a place where when you get the opportunity to borrow at say 2-3%, you take it and then put it into the system at 15% and be able to generate that delta and pay back, as at pace when you see fit, right? To be honest, why pay it back if you're able to continue to stack on top of that 15% and compound it? And then when you get to circumstances like this, then you start to say, okay, now it's time to get into more efficiency mode and make sure. So you kind of play that business cycle a little bit, when you have the opportunity.
yeah,
Um, so it's fun to listen to companies because they go through these periods of ballooning up and then paying down, ballooning up,
mhm.
paying down. And the oil and gas industry,
Dude,
very
especially
much,
oil and gas.
yeah, oil and gas
Yeah,
industry back in like the late 2000s time frame, when oil prices went from like $20 a barrel all the way to $100 a barrel, during the great financial crisis. And then they came skyrocketing down and they kind of leveled back up in 2010 to 2014 at $80 to $100 a barrel. People were just loading on debt because they were just trying to grow as much as possible. So you had every mom and pop being like, oh, I could just borrow to kingdom come and the oil price will always be there. Well, lo and behold, when the price environment switches, it doesn't necessarily look as hot and you don't necessarily make the amount of money that you were expecting. So, anyway, now the oil industry is a little bit different these days. But
mhm.
what I did want to share, Mr. Patel, unless you have other items to kind of refer to with
No,
respect to
no.
debt stacking, is our beautiful, beautiful portfolio, which is up 0.4% today, another $7 or so. We saw a little bit of uplift on NEXT, and I think a lot of that has to do with um, Tellurian and getting their FERC
Yep,
extension from the government.
yep,
So
yep,
NXT did pretty good with that. I don't know why
yep.
NEXT went up, but um, they're already developing and have shovels in the ground. So I'm a little bit curious about
I
that
think
one.
they got a secondary high, man. Everyone just got bullish all of a sudden. A lot of these index funds, that's probably what dragged them along as well. So,
Yeah.
I think a lot of times sectors now move more in sync than ever before. So, you know, yeah.
Yeah. I keep saying Orsted. I need to sell this bad boy, but we'll get to that one. Z pulled back a little bit, which I was surprised because Tellurian itself, based off of what we were talking about yesterday, and kind of coincides with NEXT, did really, really well.
You know, it's funny.
Uh,
I saw a closing price of 14.8.
yeah. Are
So
you mean
maybe
on
this is just
Z?
a little, Yeah, so it didn't actually go down very much. I don't know, whatever. What see that this is one of the things that sucks about like very thinly traded
Traded. Yeah.
securities.
Yeah.
Sometimes like it doesn't reflect right away, you know? So
And, and
I've
another
had
thing
times,
with
yeah.
Fidelity is that it doesn't show the aftermarket price. It'll
Yes, it
show
doesn't.
who the
Yeah, right.
hell is calling me this lit. Oh, it's a Amber Alert. Um, it doesn't, yeah, it doesn't show the aftermarket price. So you literally, like when Palantir mooned after hours on last Monday or whatever, it
Mhm.
didn't really reflect until you signed in the next day and the market opened, right? Which kind of
Yeah.
sucks. But if you sign in and you do it before market open or after hours trading, so you can do pre-market trading and after hours trading, it'll say the ticker. So why it doesn't have it, kind of like when you go into Google or anything like that, how it doesn't kind of have like a number beside it is kind of besides me. I think it's kind of
Mhm.
old school, but it
Yeah.
is what it is.
You know,
Uh,
so basically we set this up so that all the dividends would just keep going to buy next decade, right?
yeah.
All
Yep.
right, good.
Every, every
That's
time,
the way, bro.
every
That's
time
the
I
way.
every time I get a dividend, which we haven't in a couple days, but the last time I think we did, it was from Telz and Verizon, and I
Yep.
put that into next decade, which is why we have
Yes.
3.155 shares. So
Nice. Like I said, this is our long term, one day maybe we'll own a private jet fund, you know?
well, the hope is you get that. Like to me, the hope is that we get it to a couple $1,000s worth, and we eventually get to the place where we're like, considering it's our 50-50 portfolio, like if NEXT ends up growing to be like $100,000 position, we each get 50 grand, a year,
Yeah.
hopefully.
Yeah.
That's kind of the hope, but we need to have many more love on the Cashflow Chronicles
I'm telling
channel.
you, we'll keep doing it, dude. We'll keep doing it. We'll build out this damn portfolio to the point where everything is feeding that next decade, and some maybe to Accelera, and eventually we'll get to a point where we'll be ready. We'll be ready, dude.
Yeah,
You
yeah,
know,
it'll be fun, but that's the
yeah.
fun part, man. Yeah, I was hoping that Orsted would give us a dividend this year. They are foregoing their dividend this year, so that's part of another reason why I was like, God damn it, and I'm gonna
They might
sell it.
be. What are they doing? They're just paying down debt with that
They
with the
yeah, so
savings.
they I think the pendulum's gonna swing again. They're focusing on efficiency. They're focusing on,
Mm,
they're pulling back on growth at all costs, which is kind of what they're focusing on before. So they have
yeah.
about 15 gigawatts in operation to date. They were going to try to go to close to 50 gigawatts by 2030, and this is
Mhm,
installed and producing, right? So
yeah.
now they're focusing on getting closer to 36 to 38. So they
Yeah.
basically have trimmed their goal by a significant more margin. And I feel like the pendulum will swing back where they end up somewhere in the middle at 40, 45.
Yeah.
Um, but for now, they're focusing on making sure that they can make prudent investments. They're focusing on onshore versus offshore, and I think they just got bit too much by some of the recent press. But I think now, I mean, it's an interesting company because it was partly owned by the Danish government, and it actually
Mhm,
used to be a strictly oil and gas company. I think a lot of people don't recognize the history of this. So
yeah.
back in 2015, 2017 timeframe, they divested a lot of their capital to Ineos.
Mhm,
Sorry, not capital, their upstream assets to Ineos. And they took a lot of that money and invested into offshore wind and where we kind of are today. And they still have
yeah.
some biofuels and stuff like that. But it's kind of an interesting play because it's 15 gigawatts. And to be frank, other than Orsted and NextEra, I don't really know of any other public traded companies that are at the um, size that these guys are. You have
Mhm,
Berkshire Hathaway Energy, which absolutely has a shit ton of renewables, but that's obviously not publicly traded.
mm.
You can maybe buy it through, just buying regular Berkshire. But I would love to be able to own something that is kind of like I'm trying to find who's going to be the Saudi Aramco of renewables because somebody will be, and I
It could
think
be BIP. It could be BIP,
it could be.
Brookfield Infrastructure Partners, if you
It
wanna
could
take a
be,
look at that.
and I haven't done enough research on Brookfield. I
Yeah,
know they were getting started, and that might be some due diligence that I need to do. But um, honestly, I think it could be next era. To be very frank with
yeah,
you,
yeah.
um,
No, I agree. Could be.
um, Anyway, sorry, a little bit of a rabbit hole, but
That's all good.
there's some work I need to do with Rocket Lab. I need to make a video or two. They had a really good conversation at TD
Mhm.
Securities the other day, and so talking a little bit about their priorities and what's going on there. But
Yeah.
other than that, man, portfolio's looking
We're doing
good.
good.
We
Yeah.
got $450 in cash. So if you find anything that you think is like, bro, we got to buy something, let me know.
Nothing that I would say is, I mean, bro, I just keep adding to that Celsius, baby. I mean, it's gotten kind of, it's gotten up rather quickly, but I think there's still a lot of juice to go from here. So maybe tack on one more share of Celsius,
Okay. Yeah.
and because their earnings are coming up, so tack on that. And other than that, there's
I mean,
really
our
not
cost
much
basis is
else.
$52, so adding
Yeah,
another share, it'll
yeah,
still
it'll
keep it
raise our
below
cost
55.
basis.
Yeah.
Yeah,
It'll keep it below
yeah,
55. It won't be a big deal. Um,
yeah.
I'll put an order in for that. Bros is more of a long term.
Mm-hmm.
I'll sell Orsted.
Mm-hmm.
We got a quick 26% bump out of that. I think I might sell it in my private. I might just move it and consolidate that in my personal portfolio with NextEra, to be honest with you.
I
Um,
was thinking the day before to put it into DPST, because the regionals might start rallying under a lower rate environment. I think we are probably going to get a much cooler CPI read in February. So maybe one share of DPST. I think
yeah,
the regionals will rally. So
a
let's do that.
pulse, a pulse on it. I am
Yeah.
curious though. I honestly, I'm curious about your thoughts because I know we've talked about this one off and on quite a bit. Let me reshare my screen, the other screen that I have for this bad boy. I'm surprised that this is holding up as well as it has been.
Was it TLT?
Yeah, TLT. I honestly thought that we would see a little bit more of a pullback on this, considering we're pushing out the interest rate piece into the May June timeframe. I thought that this would have been pulling back into the high 80s at this point, and I'm just kind of
No, 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 no.
surprised.
I'll tell you exactly why. I think the market right now, I mean, even if you look at the 10 year has been pretty steady at the 4 point something last couple of days. I think it's because there's two main things that I think are somewhat jarring, but also something that can bring hope, right? So here's an example. One of the things that I said on my Twitter was that the reason why we had such a high, high inflation number was transport services, right? Transport services did not help. Basically, inflation was caused by a lot of new car prices year over year, and then on top of it, you also had not new car prices. Sorry, you had repair costs that were up there, and then you also had insurance costs. So let me just
Right.
pull that up real quick. It's BLS.
But I need this shit to go down, Chris. Like I have houses that I need to refinance. There's houses I need to buy, and I
Yeah.
have a nice bonus coming in March that I would love to either put into the market or buy another house. So the house two doors down for me is went up for rent, and I'm like, damn, if I could just refinance this place, like I'd
Yeah.
move into a new place, right? I don't care if I end up having to pay $100 or $200. If things kind of need to um, take a breather. Oh, that's mine. Take a breather or something like that. Like as long as on a monthly basis I'm breaking even, dude, I don't care. I'll go buy another house and move into that. It costs me a
Mm,
couple $100 to move. It's not that big of a deal.
yeah.
Anyway,
So people might not have noticed this, but look at this. Um, for motor vehicle insurance is up 20% year over year.
yeah, I have seen
How
this
crazy is
number.
that? 20% year over year. The reason why is because the cost of repair has just been so damn high. And then on top of it, the insurance companies now they're able to charge more because they got approvals, but that is kind of like delayed. So it got delayed till now. And so this was one of the key leaders in the inflation number. So it's one of those things that we just have to be very, very mindful of. But I think going forward, they're going to start to kind of come down slightly. And I think shelter is actually starting to come down too. So like if you go to where do you're in Houston, right?
Yeah, yeah.
Houston, Texas. Okay. So
Houston,
let's go to
Vegas.
Okay. Here I like realtor.com because I usually have like a nice little arrow here. One of the things that you're seeing now is a lot of price reductions. Like this is in my neighborhood in Atlanta, so I'm not going to go to Atlanta. So let's do Houston. Like last year, you would never see price reductions. Now you're seeing price reductions all over the place. So if you look at the map, right?
Oh, is there like a price
here?
reduction piece?
Yeah, you can see right here,
Really?
price reduced. Yeah. So if you click on
Oh,
price
okay. I thought
reduced,
it was like going to be like a heat map or something. I was about to get fired
oh
up.
no, you can.
And
There
that's badass.
there are sites that do heat maps like that. So you can see here that these are all the price reductions. Price reductions last year were unheard of, dude.
See, that's where I live. So you see that little spot, like just so there's the downtown, which you could see. It's in the middle of that spider web. There's like a little place that's like not grayed out. It's kind of like it's called the Villages. You can see like yeah,
right
there.
Here.
So I live just north of there, and I want to move into
it,
the Villages so bad.
why is it grayed out like that?
It's its own little like zip code area. It's not technically Houston. It's called the Villages. It's where all the rich boys are at. And that's I live just north of there, and I want to move into that so bad, but I don't. You know, once NEXT and all these other Rocket Lab and stuff goes to the moon, that's what we'll be talking
well,
about.
Look, the prices are coming down, man. So I mean, there's just got to go down a lot more. But
Dude.
look at this, you know, they're coming down. Like this this was 2.2 million.
See, that's what I want. I want that little over the driveway useless little bedroom. That's what I want.
With a pool in the backyard.
Yeah, I'm not a fan of that entryway, but I could see myself live streaming from one of those offices.
I don't know, man. For me, I think of housing like a sweater. You know, you just need to find one that fits you and the right size. If you buy one that's too big, it's going to be uncomfortable. If you buy one too small, it's going to be uncomfortable. So, you know, you just got to find the right size. So like right now, you're a single guy, man. You're young. Why would you want to take on a mortgage?
You're not wrong.
And like, let's say you wanted to buy this house for some reason. Like, you're just like, yeah, you know what? I have the money. I'll buy it. Your cost right now for this place estimated monthly is like $16K.
Yeah.
And you're living by yourself. You know, like you have to pay
how
like
much are the taxes though? How much are the taxes? Because let's just say I wanted to buy a cat. How much
dude, it's the taxes are just
the taxes are going to be what's the problem?
Let's see. I wonder when they had their last appraisal, monthly payment, property tax. Oh shit, $3 grand a month in property taxes.
36 grand. That sounds about right.
Damn. Yeah.
And that's with homestead. If you don't have homestead, dude, you're fucked.
And then another 1766 for home insurance, bro. Get the hell out of here. Combine that's like $5 grand a month and just non-operate. Yo, bro, I'm comfortable where I am. I'll live in my little shoebox apartment. I'm fine, honey. We're not moving. We're staying here.
Nah, man. I find there's a lot of beautiful homes in the area for $550.
No,
and
this is joking.
Beep beep.
I said we're not moving. We're staying here forever. We're not moving to Texas. Get out of here. You see their property taxes over here? You're freaking out. They're freaking outrageous.
Well, we don't have state income, right? So that's
whatever.
Bro,
36 grand. That's more than 36 grand.
Yeah,
it's like almost 40,000 in property.
That's what people were like. Oh, you guys don't have state income tax. It's like, but our property taxes kind of suck, right?
Yeah. And then home insurance, dude. Home insurance is 1766.
Yeah, that's absurd, man. I pay $80 a month. I don't know why it'd be that much.
Tacos, margaritas.
I don't know, whatever.
Fajitas.
Get out of here. Get out of here, man. Stop giving her reasons to dream, okay? I've been swatting away her dreams for the last 5 years, and you're out here trying to ruin it and trying to get her
to move to Austin. What's the dream?
No, the dream is to live a rich person's life, and I'm fucking cheap as dirt, bro. You know where this T-shirt came from? Amazon. I buy them wholesale on Amazon. All right.
Yeah, good man.
Huh?
Good man.
I know you're not bougie, dear. I love you. Let me finish.
Aw.
All right. Don't kill me. Bye.
You guys are great.
Yeah.
All right, man. Well, I'm trying to think. There was. I feel like there was one other thing that you mentioned. You said the debt stacking piece. Trying to think. Other than that, we might be able to call it, and you can go get abused. And find out if you're sleeping on the couch or not, because
I'm always sleeping on the couch. Me and the couch are friends. You know, I'm okay with it.
you're like worth
Mhm.
it. I do
It's that
ask you
time of the
guys.
month again anyway, so it's all good.
I do ask.
I think I just shared a little too much information.
You
Now
know,
I'm
man.
definitely on the couch.
Yeah, I
Now I'm
was about to
definitely
say,
on the
I'm
couch.
gonna
Now
send
I'm
you a
definitely on the
shovel,
couch.
man. I'm gonna send you a shovel because you're always just digging yourself a fucking deeper hole. Love it. Please, if you guys haven't already, subscribe to the new channel. We're getting close, almost 800 subscribers. We're almost at the amount of watch time that we need. Really looking forward to moving over to there full time with Chris. I was delayed in getting home, so I will put up last night's episode up there immediately. So if you guys are interested in watching that, if you guys want more Cashflow Chronicles, you're only able to catch half of this. Be sure to do that. Otherwise, this one will be up tomorrow. I will be working from home tomorrow, so hopefully it'll be midday. If you guys want to replay, listen to anything, it'll be up. Chris, is there any last words for the February 15th Cashflow Chronicles number 72?
Nah, man. Just take care of make sure you start your taxes now because you try to do them next month, you're gonna be
Good
in a
point.
world of hurt, man. So right now, get all your paperwork together, get your CPAs together, whatever they need, get that shit done now. Cause if you wait, bro, it's gonna be a bigger headache later on to search
You
for
want to
that
know
stuff.
what's good for me this year? So
Mhm,
last year I didn't have this luxury. So because I have international tax problems because I moved to Trinidad in 2019 to 2020,
mhm.
um, for a lot of the years after I got back, I had the company provided me somebody to do my taxes.
That's
I didn't
nice.
have it last year, so that kind of sucked. But this year again, I don't know if it's because I had shares in UDoc that vested or something, but they gave me somebody. So that thank you for the reminder. Tomorrow I will probably knock that out. So that way when I go to Mexico next week, I'll literally just be like, I'm
Yeah.
done. Everything's all taken care of. I got all
Yeah.
my
Get
work
all your
needed to be done.
W-2s,
Yeah,
get all your
that'll be good.
W-2s, get the mortgage interest, deducted. Do you itemize or do you do standard?
Last year, I need to double check if it was enough too, because I really only had the one property. This
Mhm.
year will definitely be sufficient enough, absolutely. But last year, I feel like I should. Um, so we'll see. I'll see what probably because I'm thinking like I only had this for one mortgage payment, this house for one mortgage payment, and then I had the rental property. The rental property
Yeah.
on 50/50. So I honestly, it would probably be prudent because I think the interest last year just on the rental was like 22 or 23. So divide that by two, it's like close to
Mhm.
12 grand anyway. So plus I think I paid 2 grand in interest just alone on this property. So it's definitely close. I wouldn't be
Yeah.
surprised if I itemized for the first time.
That's
So
that's one of the good things about buying a property and a house. Like, even if like right now you take on a 7% mortgage, most of the initial 5 years you're going to be paying pretty much mortgage interest. So if you're at the top of your tax bracket, you'll get a 30% discount for that.
yeah.
So a lot of
Mhm,
that mortgage interest you can use towards reducing your taxable income. So if you
mhm,
factor that in versus rent, which is not taxable income, you can see that actually might be better to buy a house.
mhm.
But like I said, there's a lot of factors that
And
go into it.
my uncle actually told me that he's like, even if you're breaking even, when it comes in cash flow out, cash flow in, cash flow out, he's like, technically you'll end up making money at the end of the year because of all the benefits of real estate. He's like,
Hmm.
so you might not
Yeah.
see it initially, but he's just like, generally speaking, and he's like, always, he's like, find a good line, where
Hmm.
you don't always want to have like a 80% loan to value ratio. He's like, but
Hmm.
he's like, if you find something that works for you, like say 65% or something like that, he's like, then you could always take money out if say you have a portfolio of properties. He's like, you could always take money out when it gets close to like 50%, take out 15%, go buy another property. He's like, and then at that point, like you're saying, like you'll have enough interest that's always kind of offsetting part of your income that you end up getting a nice chunk of change at the end of the year, or offsets your dividend income or something like that, where so it'll be fun because I've never really been able to play that game as of yet, and I hope to plan to buy some other properties as well, either this year or next. So fingers crossed.
Yeah. All right.
Cool.
Talk to
You
you
guys
later, man.
rock. Thank you guys.
Later.